CapSim Simulation Masterclass, Online Lecture Script, Part 3 of 4, Title, Making Round 1 Decisions, From Strategy to Execution Studio Microphone. Welcome back to Part 3 of our CapSim Capstone Masterclass. Now that we've interpreted the Capstone courier and completed the situation analysis, it's time to make your first set of official decisions. Round 1 is foundational. It sets the tone for how your company will grow. I'll walk you through each functional area step by step using academic and practical insights. Let's begin with R&D. Slide, Step 1, Research and Development. In R&D, you're adjusting your product specifications, performance, size, and MTBF, mean time before failure. Your goal is to position each product as close as possible to the customer's ideal buying criteria for round 1. Pushpin key rules to remember: moving a product on the perceptual map resets its age by half. Higher performance equals better function. Lower size equals more compact. R&D revisions take longer if automation is high. Let's take Able, your traditional product on Team Andrews, as our example. According to your situation analysis, round 1 target, 5.7 performance and 14.3 size, MTBF, traditional segment between 14,000 and 19,000 will set MTBF to 15,000, balancing reliability and cost. You enter these values in the R&D spreadsheet, click Recalculate, and observe the following. Revision date, e.g., March 15, 2020. New age at revision, drops from 3.1 to 1.7 years. R&D cost, shown next to the product row. Now repeat this process for other products, acre, low-end. No changes in R&D during round 1. Customers value high age, so avoid resetting it. Atom, high-end update specs to approach 9.8 performance and 10.2 size. But watch your revision date. If it pushes into next year, scale back changes so it finalizes in 2020. Aft, performance, prioritize performance and MTBF. Agape, size, move toward a smaller size and decent performance. After you update all products, save your official decisions. Slide, Step 2, Marketing Decisions. Next, move to marketing. Here, you'll set price, promo budget, sales forecast. Very important, start with pricing. Refer to your Capstone courier's segment pricing ranges and adjust accordingly. Magnifying glass tilted left, traditional, expected range in round 1, $19.50 to $29.50. Set price for Able at $28, competitive and within expectations. Magnifying glass tilted left, low end, price sensitivity is highest range, $14.50 to $24.50. Competitors are at $21. Set acres price slightly lower, say $20, to win market share. Magnifying glass tilted left, high end, price is least important range, $29.50 to $39.50. You can charge high. Try $39 for Atom if your specs are strong. Magnifying glass tilted left, performance and size, balance between specs and affordability. Stick to upper mid of acceptable price range. Now let's set the promotion and sales budgets. Pushpin general rule: promo budget, $1.5 million per product equals 36% awareness. Sales budget, $3.0 million per product equals 22% accessibility. These amounts give optimal returns. Spending more has diminishing value. You can adjust these values in future rounds once awareness and accessibility are high. Slide, Step 2.5, Forecasting unit sales. Forecasting is one of the most important and risky decisions. Use this proven conservative forecasting formula. 1. Get last year's total industry demand, from Capstone courier, OEG, traditional equals 7,387 units. 2. Multiply by segment growth rate, OEG, 7,387 times 1.092 is equal to 8,067 units. 3. Multiply by your market share, OEG, 8,067 by 16.7% equals 1,347 units. This is your conservative sales forecast. Enter it in the sales forecast box. Use a similar method for each product. Important: don't trust the benchmark prediction blindly. It's often overly optimistic. If in doubt, forecast slightly lower. It's better to have leftover inventory than to stock out. Once you input all forecast numbers, recalculate to see estimated revenue, variable cost, contribution margin, and net margin. Then move on to production. Slide, Step 3, Production Decisions. Production determines how many units you'll produce and whether you'll expand or shrink capacity. Pushpin formula. Production schedule equals sales forecast minus inventory on hand. Let's say for Able, forecast equals 1,347, inventory equals 189, production equals 1,158 units. Enter 1,158 into the production schedule cell. Next, check your first shift capacity. If your production exceeds this, you'll use second shift, overtime. Overtime labor costs 50% more. You can also adjust. Capacity takes 1 year to take effect. Automation also takes 1 year. When to increase capacity? If your forecast growth is significant, if your stockout risk is high, if your utilization is consistently 150% or more. Pushpin cost to increase capacity equals units added times $6 plus $4 times automation level. Pushpin automation range 1 to 10. Higher automation equals lower labor costs but slows down R&D strategy. Tip: leave automation at 4.0 for dynamic products like Atom, high-end. Raise automation for stable products like Acre, low-end, to 6.0 or higher after entering all production numbers and updating capacity or automation as needed. Recalculate and save your official decisions. Slide, Step 4, Human Resources and TQM. If enabled, if your instructor has enabled HR and TQM, this is where you'll make additional efficiency decisions. Pushpin HR decisions. Recruitment spend reduces turnover, boosts productivity. Training hours increases labor efficiency, lower cost per unit. Pushpin TQM. Total quality management investments reduce R&D cycle time, materials/labor costs, and increase product appeal. Effective spending range $500,000 to $1,500,000 per initiative. Spread TQM investments across multiple rounds rather than overspending in one go. Slide, Step 5, Finance Decisions. Finance is your final step. Here, you manage cash flow and fund your strategic choices. Rule number 1, avoid emergency loans at all costs. If your estimated ending cash position is negative, you must raise funds via current debt, short-term, auto-repaid, long-term debt, bonds, common stock, equity, dilutes ownership. Pushpin suggested approach: use long-term debt to fund capacity/automation. Only use common stock if your debt ratio is too high. Avoid paying dividends in early rounds. Reinvest all earnings. Let's say your forecast cash shortfall is $10 million. Issue $12 to $15 million in long-term debt to cover it with cushion. You can always repay debt later when profits improve. Slide, Final check before advancing the round. Before you click Advance Round, do this checklist. White heavy check mark. Have you aligned R&D specs to segment ideals? Priced products correctly? Forecasted sales conservatively? Scheduled enough production with some buffer? Adjusted capacity and automation as needed? Funded operations with a positive cash balance? If yes, click File Update Official Decision Save. Congratulations, your Round 1 is ready. Slide, What to expect after Round 1. After advancing to Round 2, open your new Capstone Courier. Here's what to look for. Did you sell out? If so, produce more. Did you overproduce? Adjust forecast down. Is your contribution margin greater than or equal to 30%? Good job. Did your stock price drop? Check earnings and loans. Did you gain or lose market share? Track your mistakes and optimize your strategy. Closing slide, Fastest support TO get top results $9.99 for CapSim, email, behelp2002@gmail.com, blog, https://capsimguide2021.blogspot.com, free Excel file for all 8 rounds, download from blog or send the email. Online quick support Q&A equals WhatsApp equals https://bit.ly/3silp9u. Whole game support equals $50 for 8 rounds equals top results. This wraps up part 3 of our CapSim Capstone Masterclass. You've now made your first round of strategic decisions, a major milestone. In part 4, we'll analyze post-round 1 performance, explore how to add new products, and refine your game plan for long-term success.